HubSpot invented the blog as a business tool. It taught an entire generation of companies to publish content instead of buying ads. It grew from a garage idea into a company worth $40 billion. And in the last 2 years, it lost most of that value while its revenue kept climbing. This is the strange story of a company that won the war it started, then found out the battlefield had changed underneath it. Before HubSpot existed, marketing was something companies did to people, not for them. Television commercials interrupted shows. Radio ads interrupted music. None of it was requested, and by the mid-2000s, people had gotten very good at ignoring all of it. Two graduate students at MIT, Brian Halligan and Dharmesh Shah, noticed something interesting happening on the other side of that equation. Buyers were no longer waiting to be pitched. They were searching Google, reading blogs, and researching products entirely on their own terms, long before a salesperson ever entered the picture. So in 2006, Halligan and Shaw built a company around a simple bet. What if a business could get found instead of chasing customers down? They called the idea inbound marketing, and by 2010 they had written the book that gave the strategy its name. HubSpot became the proof that the inbound marketing strategy worked. The company built free tools that solved small, annoying problems for business owners. Website Grader let anyone enter a URL and get a free report on their site's SEO and performance. Between 2006 and 2011 alone, it graded more than 4 million websites. A companion tool, Twitter Grader, worked the same way but added a social layer. People shared their scores publicly, which pulled in even more visitors who wanted to check their own numbers. Underneath all of this sat the real engine, the blog. HubSpot published relentlessly, eventually running what employees nicknamed the Content Factory, a room dedicated entirely to churning out articles. A single blog post could pull in 100,000 visitors over its lifetime, convert 2,000 of them into email subscribers, and turn 100 of those into qualified leads for the sales team. Posts written years earlier kept generating leads long after they were published. None of this was free in the sense of costing HubSpot nothing. It was free for the reader, and that was the point. The blogs and tools brought people in the door. The actual revenue came from selling CRM, marketing, sales, and service software on a per-seat, tiered pricing model. Give away real value, then sell the software that makes that value easier to act on. It is a formula that countless SaaS and SEO companies have copied since, but HubSpot ran it first and ran it at scale. The results were hard to argue with. HubSpot brought in $255,000 in revenue during its first year. 3 years later, that number had multiplied 61 times over, reaching $15.6 million. Investors noticed, including Sequoia Capital and, in an early and ultimately ironic move, Google itself. HubSpot went public in 2014 at $25 a share, raising just over $133 million. Most companies slow their growth after an IPO. HubSpot did the opposite. Revenue climbed from $271 million in 2016 to $675 million by 2019, with more than 73,000 customers on the platform. Then the pandemic hit, and every business that had been putting off its digital transformation suddenly had no choice. HubSpot's customer count jumped 39% in a single year, crossing 96,000 customers. By 2021, revenue passed $1.28 billion. By 2024, it had doubled again to $2.63 billion, spread across nearly 248,000 customers. Zoom out far enough and the trajectory looks almost unbelievable. Revenue grew more than 10,000 times over between 2007 and 2024. The customer base expanded nearly 20 times just in the years after the IPO went public. For close to 2 decades, growth rarely dipped below 20% a year. From the outside, HubSpot looked like the professional face of modern marketing, a company that had figured out the future of how businesses reach customers. On the inside, it was one of the more unusual workplace cultures documented in tech. In 2013, journalist Dan Lyons joined HubSpot in a loosely defined role called Marketing Fellow. He later left and wrote a book about the experience, and the details he described paint a picture of a company that had taken every startup cliché and pushed it further than most. Bright, toy-filled offices divided into neighborhoods named after parts of Boston. A wall of candy, bouncy ball desk chairs instead of real ones, Nerf gun battles in the hallways. A room of employees writing content packed so tightly together that Lions compared it to a garment factory, a space staff themselves referred to, without irony, as the content factory. The culture extended past the decor. Company parties that started in the late afternoon and ran long into the night. Employees swapping desks every few months under something called a seating hack policy. Layoffs rebranded internally as graduations. A co-founder who reportedly brought a teddy bear into meetings to represent the customer. It was the kind of environment that could genuinely feel exciting to some employees and deeply strange to others, often at the very same time. HubSpot won multiple Best Place to Work awards during this exact period, which tells you something about how differently the same culture can land depending on who is describing it. Lyons' book, Once HubSpot Executives Learned It Was Coming, was treated internally as a real threat to the company's stock price and reputation. What followed escalated well beyond typical corporate damage control, involving attempts to access an unpublished manuscript and enough concerning activity that the FBI opened an investigation. The fallout led to the firing of HubSpot's chief marketing officer, the resignation of its vice president of content, and formal sanctions against co-founder and CEO Brian Halligan for failing to inform the board in time. Strange as the whole episode was, it did not slow HubSpot down. If anything, the book's portrayal of a chaotic but fun workplace may have helped recruiting in an industry where eccentric startup culture was already the norm. HubSpot's stock hit an all-time high in September 2021, closing above $850 a share, a 34 times return on its original IPO price. The company was valued at roughly $40 billion. It looked untouchable. The first crack appeared in January 2023 when HubSpot announced layoffs for the first time in its history and consolidated its office footprint. But the deeper problem was not coming from inside the company. It was coming from the same place HubSpot's original growth strategy depended on, Google. In April 2024, reports surfaced that Google was exploring a $35 billion acquisition of HubSpot, which would have been Alphabet's largest acquisition ever. Talks appeared to progress through May. Then on July 10, 2024, the deal quietly collapsed with no official explanation. HubSpot's stock dropped 19% that day, its worst single-day decline since 2020. The most likely explanation has less to do with HubSpot and more to do with Google's own legal exposure. At the time, Google was already fighting extended antitrust battles over its dominance in search and search advertising. Absorbing a major CRM and marketing software company on top of that would have invited exactly the kind of regulatory scrutiny Google was trying to avoid, regardless of how well HubSpot itself was performing. The real damage came later that same year, and it struck at the core of everything HubSpot had built since 2006. In 2024, Google rolled out AI overviews, placing AI-generated answers directly at the top of search results. People stopped clicking through to blogs the way they used to. They read the summary, and if they were curious, they might glance at a cited source. For a company whose entire growth model depended on ranking content and pulling in readers, this was close to an existential problem. The numbers made the shift impossible to ignore. HubSpot's monthly blog traffic fell from 13.5 million visits in November 2024 to 8.6 million just 1 month later, a loss of nearly 5 million visits in 30 days. Pulled back further, the decline is even starker. In March 2023, HubSpot's blog drew 24.4 million monthly visits. By January 2025, that number had fallen to 6.1 million, a drop of roughly 75 to 80% in under 2 years. Part of the problem was self-inflicted. For years, HubSpot had ranked content for topics with almost no connection to its actual product, things like resignation letter templates or famous quotes, simply because that content drove traffic. That approach flooded the site with unfocused content, which made it harder for Google's newer, expertise-driven algorithms to identify what HubSpot actually specialized in. The company eventually deleted more than 30,000 blog posts and later admitted the strategy had been showing warning signs as far back as 2020. In 2026, HubSpot beat expectations, growing revenue 23% to $881 million, crossing close to 300,000 customers, and raising its own forecast. It rolled out a survival strategy built around outcome-based AI pricing, where customers only pay when an AI agent successfully resolves a support ticket, alongside broader price cuts and free trials. Reportedly, HubSpot's AI agents are now resolving around 70% of support tickets across roughly 9,000 customers who have activated the feature. Among AI-generated answers across its category, HubSpot is reportedly the most recommended brand. And yet, the market punished the announcement. The stock fell 19% the day after the pricing shift was unveiled, as investors read the move not as innovation, but as a company discounting its way through declining demand. HubSpot is now valued at roughly $11 to $12 billion, down from nearly $40 billion at its peak, even while revenue keeps climbing and the company is now solidly profitable. HubSpot spent 2 decades building the most successful content-driven growth engine in software history. It did not fail because the strategy stopped working. It struggled because the platform that strategy depended on, Google Search, changed the rules in the middle of the game. The same question now hangs over every company built on blogs, SEO, and seat-based software pricing. HubSpot is simply the most visible test case because it built its entire empire on the exact thing AI search is now replacing. Whether HubSpot's pivot to AI-native pricing is the start of a genuine second act, or a company managing a slow decline as gracefully as possible, is still an open question. The revenue says one thing, the market says another.